Hello, welcome to this video. Before we get started, please read the disclaimer. Trading is risky. Please do your homework. This is not trading advice. Alright, let's get started. Next we're going to calculate the money and risk management. In other words, how many shares or contracts to trade. They also call this calculating the unit size. So again, you see that it uses ATR, and it also takes into account the size of your account and how much risk you're willing to take. So this is actually a very powerful element to the strategy itself. When I first tried to trade, I didn't have any concept of money and risk management. I mean, I kind of had the idea, well, not to risk a huge amount of my account. However, I didn't really have a method to allocate, well, how many contracts or how many units of something should I trade. And this totally answers that. So this is where you see how everything incorporates. So let's assume for risk management, let's just say we have an account, or let's even use the example I'm using. We have a $2,000 account. And we need to determine, well, on any given trade, how much are we willing to risk? This is somewhat of a personal choice, and what's suggested is you risk anywhere from 0.5% to 5%. 5% being on the high side, 1% being on the lower side. So for the trades that I'm doing, I am risking 1%. I am willing to risk 1% of $2,000. So I am risking $20 per trade. So no matter what market it is, I'm going to risk $20. And so, well, how do you actually allocate this $20? Well, let's take a look at this market. I'm going to use this particular platform to demonstrate it. The numbers and the math work the same regardless of the platform. It's just going to be easier to see how it is when I kind of punch numbers in. So what we're going to do is start with the ATR. So the ATR we have here as 0.58. So ATR equals 0.58. So we know that calculating the stop uses 2 ATR. So that's going to be 0.58 times 2, 1.16. 1.16 is the value for our stop. So 1.16 is the amount of price movement that is going to occur before we get stopped out. Now the question is, we need to turn that into money, into actual dollars. So what's the dollar value of the 2 ATR move? So to find the dollar value of the ATR move in my particular case, I'm going to just go into the system itself, and I'm just going to click buy. That's going to bring up a window. And I am going to put the initial stop. So let's just say I put in, what do we calculate it as? 1.16. So I'm going to put in 1.16. I put in without a decimal because it's taking it in terms of pips, which is, this is kind of the pip level. So we see that for 1.16 ATR, which is the 2 ATR, right? 1.16 is the value of the 2 ATR, which will be our stop level. If we get hit at that, that's going to be $1.74 Canadian, which is the currency of my account. So the dollar value is 1.74. So now I take these two values to figure out how much I could trade. If I take my $20 is what I'm going to risk, which is 1% of the 2,000, and I divide that by 1.74, which is the value if I get stopped out, and I divide that 20 divided by 1.74, I get 11.49. So 11.49 contracts, stocks, units, whatever you want to call it. Now, since I can't get 0.49, you can either choose to round up or round down. I will round it to 11, And so if we go back to the trading platform and I say I want to trade 11 units, you'll now see 11 units with a 1.16 stop is going to have an initial loss value of $19.15. So if I round it up to 12, you'll see it would have gone to $20.89. So again, this is using this particular trading platform. It's not that there's anything magical about the trading platform. This is just an easier way for me to get the dollar values. If you're trading futures, then each contract will have a dollar value per point. So if, for example, this was a futures and we were using the same stop level of 1.16, and let's just say each point was, I don't know, $50, then you would know that 1.16 would have a dollar value of 1.16 times 50, which would be $58. You would repeat this process of dividing your dollar value of risk divided by dollar value of stop. So again, I hope you understand the dollar value of risk is very simple. It's the percentage you're going to risk of your account. So in this case, $20. I'm going to divide it by the dollar value of the stop, which the stop is 1.16 multiplied by the contract value. And in my particular case, I just use the broker's system to determine how much this particular amount of stop is it going to be in a dollar form, to which I put that here, dollar value of stop, and I divide it to which that's going to equal number of contracts units to trade. And so that answers the money/risk management element, or how much are you going to trade. And so looking at all these three components, when you start to play with it, I hope you're going to start to see that all of these choices, all of these decisions all fit together to make a very cohesive trading strategy. You're getting into trades when the market starts moving in your direction. You place stops based on values dictated by the market and its range. You risk an amount set to a choice between 1 to 5% of your risk tolerance, and you trade an amount based on where your stop is going to be in coordination with how much you're risking. And so all of it fits together into a very robust trading strategy. In our next video, we'll talk about diversification and also start walking through how to apply this in an actual trading situation.